ultimately, I just think people need to put this back into a supply story and think, come on, next year, is it likely we're going to have more or less shale oil? Is it likely we're going to have more or less heavy crude with Venezuela back, with OPEC kind of in the midst of like a very deep cut? It's all pointing to a lot more supply. Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Newman, the Chief Executive of Onyx Capital Group. I'm joined today with Martha Dowding on the research side, and we've got another market podcast as normal. Just a quick reminder to please watch this on YouTube if you want to see the graphics and the visuals, and also please show us some support, clicking notifications and liking episodes. That'd be great help. Thank you. So Martha, just starting with outright prices as normal, what's been going on in the last week?
Yeah, so we've seen this really significant sell-off down below the, psychological level of $80 a barrel. And then over the past couple of days, we've seen this resurge back over 82.75 this morning, comfortably above the lower Bollinger Band, as we can see in this graph here. So we're kind of recovering from that huge sell-off and kind of maybe making kind of a new normal above 80 again here.
Yeah, I think that's quite normal after a significant sell-off, right? You have liquidation, a big washout. It's a good indication the market's shifted its thinking. It's given up on the bullish kind of thoughts above 90 or $100 per barrel at least. You get this big sell-off, and then, as you say, I think you actually pointed this out a few days ago. We're way below the RSI as an indication, but generally speaking, you tend to consolidate and you tend to pick up a bit before resetting again. So you either kind of resets and goes again, starts a new trend, or I guess we've had enough of the de-risking that we could even possibly start a new bullish trend. But why don't you talk about the that shift in positioning? I guess who was causing this?
Yeah, so in terms of de-risking, looking at the CFTC report to November the 7th, we've seen pretty significant de-risking. We've seen 50 million barrels of managed by money, so funds, long positions being taken off the market, and a reassertion of short positions. This is a pretty significant week-on-week change percentage-wise if you're looking at the graph, and that's about 6.5 million barrels of short positions put on. So a definite significantly a good space for these short positions now. And I think in WTI, we're seeing this same kind of attitude where the managed by money positions closed about 2.2 million barrels, and that brings the low spec interest to the lowest level since July. And we've seen the short positioning increase as well to 22 million barrels in TI. Yeah,
I mean, the open interest has fallen off a cliff, it looks like, in the last week in particular. So managed money, fast money, let's put it, adding shorts and obviously exacerbating the move. But you've got to say what it looks like is, whatever the market's going to do, I'd rather just be out of it and wait for the new indications from probably OPEC next week on their meeting, and start the new year with looking for more conviction. So it basically very clearly tells you that the market was clearly net positioned long on a spec basis, because if you're de-risking and the market goes down, then that tells you everything you need to know. So it's pretty classic. I think it's just running out of steam once again. We kept trying this year to have a bullish run, and it ended up being a very, very range bound year. So, there's only a month or so left of the year, and particularly trader bonuses, the majority being end of year. You're better off just not doing anything if there's not anything that clear. But, clearly there are still traders active. And as we said, the fast money, the hedge funds, they're in short now, kind of trend following. There's probably a fair amount of investor involvement that doesn't ever tend to really die down to zero. So I guess that probably means the less professional market or less commercial market is driving things at the moment. So going back to probably macroeconomics. But other than that, what do you think, what else is driving, I guess, people's views right now?
Yeah, I think that's really interesting what you say about it being the end of the year and bonuses and stuff. And we have the OPEC meeting next week on Sunday that will have the full release. And do you think that is too close to the end of the year for OI to properly increase, or for players to be really confident about re-entering the market?
Yeah, it's the same thing every year. I mean, going back to say 2021, before there was any kind of idea that I guess the Russia-Ukraine thing would kick off as much as it did, we were in a bullish market, but then we had that Black Friday. I don't know if you heard about this. There was
the sell-off.
Massive sell-off, kind of quite similar, to be honest, to the recent one we've had. And it was, again, a de-risking situation, producers rushing in to hedge what they can by the end of the year. And it left a market kind of oversold effectively, clearly. And what's good about that for some traders who are like retain their view or are very confident in their view is that you have a lot thinner of a market and a less overextended market. So if you're bullish when everyone's bullish, you know, you need a hell of a lot of weight behind you for it to go even further. But when everyone's de-risked, you know, the small bits of buying flow you do have now will move the market materially more. And so you tend to get quite like sustained moves in this kind of low liquidity environments. And in particular at the end of the year. So as everyone winds down, thinks about the Christmas holidays, 2021 in particular, we had a pretty significant rally. And you're talking about making like, I don't know, 5% return on Brent for majority of the year when you're long and you know, happy about that. And then like overnight, there's like a 20% return on Brent because no one's in it. And that can happen in these low liquidity times.
Yeah, that's really interesting. I think that we often speak about kind of the financialization of the market kind of somewhat diluting these bull plays that people can do. But maybe now this will be kind of a time when people can kind of see the opportunity to do these bull plays and kind of rush into the market. Yeah,
if you genuinely believe in it, it's a good entry level. And I think the way I look at it is you have producer merchant, it is on the CFTC, but let's just call that trade houses and majors. They hold like a disproportionate amount of volume compared to the wider market. The reason why hedge funds and short-term money, despite being a lot lower volumes, they have quite a big impact on the price, is because they're in and out, right? And they're making these buy moves or momentum-based moves. Whereas, you know, a major or trade house will buy, hold, and that's it. So the problem with that is that in, like, say this year, you've been waiting for a big rally, let's say, but everyone who can, like the majority of the traders who are long are already long and they're just waiting. So they're kind of reliant on the hedge funds or fast money taking it all the way.
Yeah.
So in an environment like now, you've actually washed out the majors and the trade houses, and ultimately one of these guys getting back in is going to be such a lot of volume that it will cause a material shift upwards, do you see, or downwards if they choose to. But the point is that they have a lot of volume to move markets when they want to, but once they're invested, that's it.
Yeah.
And I think if anything, the liquidation showed you that whilst it might have been some hedging and all that, it was probably likely trade houses and majors getting rid of these annual positions and just thinking, let's take a breather.
Yeah, I mean, and that's another way that's a way that TI and Brent has kind of have seen different flows this week. Looking at the CFTC report for, I guess last week to November the 7th, you can see there was a huge liquidation event from Prodmerc positions, and it was the most substantial closure of positions since the start of April. Sorry,
this is both adding shorts and getting rid of longs, or both?
So the long weekly change, so this is week on week change, so they're both closing positions.
Oh, they're both closing. So everyone's closing positions, but there was more longs closing positions than shorts. Percentage-wise. But yeah, that's absolutely indicative of, closing out basically of the core position.
Don't want to risk putting on any new positions, like no
and I guess then therefore it's not surprising you get such a big move. You know, $10 per barrel is probably what you'd expect with, you know, the majority of the market's volume suddenly exiting. And I think they've probably seen enough to know that, like, you just have to bite the bullet and get it done. And because the momentum in the market these days is so much, you know, with the fast money, with the CTAs, that if you just sell and wait, like you could see $10 fall before it rebounds. And that's just very much the market these days. That's a really interesting one. Okay, so focusing, I guess, on OPEC a little bit now, because that's what's coming up. We've got a recent forecast that they've come out with, right? When we talk a bit about that.
This is like pretty significantly different to the IEA, whose last month forecast a little less than 1 million barrels a day in 2024 next year. So, I mean, they just seem so distinctly different situations.
What you can see for yourself, supply and demand forecasting is pretty much an art rather than a science.
Yeah.
I mean, at the end of the day, I mean, I was discussing this with Miles, commercial director on the research on a podcast as well. It's like when people say that supply and demand forecasts are correct or they end up being correct, I don't actually know what that means, because when is there a moment in time where you validate what your supply and demand was? Because I don't think you could get anyone to say, pick a moment in time and prove what the supply and demand was. There's so much degrees of inaccuracy that's possible, right? There's, government agencies might have made their public information wrong. They might have put like a decimal point where that's going to happen, right? There's any kind of variability, and there's so much oil moving around the world being bought and sold to actually know what the end result was. I mean, it's actually almost impossible within a degree of accuracy of like less than 5%, you know. That's how it seems. So when they say 2.25 million, it's like, I just don't, does it matter? I mean, they're just basically saying there's going to be enough demand to satisfy maybe them bringing back production from their cuts, and maybe that is a signal to market that it's probably coming in a weird way.
Interesting. Yeah. I guess it's guessing what's going to happen with a million moving parts moving in a million different directions. It's going to have, you know, a million different forecasts. And I guess it's more them saying that it's going to grow rather than the actual figure itself.
Yeah, and to say it's going to grow in general, I mean, it's not great for the renewable story, but, you know, this is up to like 103, 104 kind of million barrels per day now. So that's growing despite everything. So I guess, I don't know, you ask the average Joe, like, is that true? Do you expect to continue to be using oil? Oil's kind of a bit back in fashion this year after the cost of living crisis. There's a lot less pressure to be conservative about these things. So I can kind of see that argument. And then you've got the classic, you know, emerging markets is still a huge deal, right? But then Chinese economy has been waning for a long time. That's why I've never been a huge fan of supply and demand in general, forecasting. It's like, how can you possibly know what people are going to do next year? So I prefer to look at the supply side. And the supply side is, I think, the most interesting story. People don't like to talk about the US shale. There's been a continued narrative that, look, guys, they're being really conservative, but the numbers just don't back that up. At the end of the day, with the big acquisitions we had at the tail end of this year, clearly there's a commitment to produce a hell of a lot of US oil, as much as they can, basically. We've got a Trump administration possibly coming back at the end of 2024. And I know that's a while away, but, you know, people start to make their views on this early. And again, they've probably made a view that they're going to be supported in their oil and gas licenses. And I think the mandate coming from Trump is, generally speaking, to get the oil flowing, to kind of boost the economy that way, more jobs and all the classic stuff. So I personally think it's still going to be that story, and it's even more influential on how much is being exported into the dated Brent benchmark. And, you know, we've just seen the last week or 2 weeks, let's say, when freight gets really high, which it has done, and it blocks exports into Europe, you know, the whole dated Brent complex now gets decimated, or it has a big impact, because it genuinely is so linked to the US now. So suddenly it puts a hell of a lot of meaning into these EIA stats, and we're building again. And at the end of the day, the only thing that goes against what I'm saying is the SPR thing again. But ultimately, I just think people need to put this back into a supply story and think, come on, next year, is it likely we're going to have more or less shale oil? Is it likely we're going to have more or less heavy crude with Venezuela back, with OPEC kind of in the midst of like a very deep cut? It's all pointing to a lot more supply. And I guess the hope is for these guys that the demand will outpace it. But that you just cannot know. And you've got to find some way to almost like hide the oil. I don't know, like how are you going to, you know, the inventories have to build at some point. And maybe it's a smart move to, you could almost make a bilateral agreement with the US to help them fill back their SPR. And from the headline inventory point of view, no one's going to basically pay too much attention to it being rebuilt. But that's, you know, a couple 100 million barrels to be refilled. That could help that story. It was the only thing I could think of. But a lot of rambling. Yeah, what else can you do? We're talking about next year. We're talking about like, we're just not that sure.
Well, no,
yeah,
not at all.
And it doesn't seem like anyone really is. So it'll be interesting to see what OPEC do and whether they can basically just keep getting deeper.
I think it's interesting saying like that political aspect in the US with shale, because it is so political there. I think that like consumer wise, just like being on oil Twitter or whatever, you see these people just so burnt by, you know, the inflation, and obviously the Inflation Reduction Act put so much kind of influence onto renewables, and that was like, oh, this is what's gonna help us, and that has not really kind of helped the consumer. So I think in terms of you saying that people are ready to kind of trust oil again, I think that might, you know, help swing things a little. And there are genuine worries about the SPR, whether people really know what it is or not, but I think it's such a good buzzword. Like, yeah.
Well, you can just say, but what about that? And what about that? And ultimately that's it, right? It's sentiment. It's just that clearly the market is showing you with this open interest decline, there is not a hell of a lot of conviction at all. And even like VTOL came out not so long ago saying between 80 and 90. So it's not like they were super bullish. That's probably echoed with a few of the trade houses. You got some banks saying 100, 120 again, but it's just falling on deaf ears because it's just not believable. So we need like a new believable theme. And again, going back to the forecast on the demand side, I guess that's your best bet now. It's like, but can we get everyone excited about demand again? And if we do get a soft landing in the macroeconomic landscape, I guess I can see the logic in that. But if you don't do that, like, I don't think anyone's going to believe the supply story is tight and this lack of investment narrative is just obviously complete bollocks.
No.
So, right, moving on then.
So there's two big headline macroeconomic things to be watching this week. The first is the US CPI release, which is actually today. Probably will have happened once this is released. Yeah. But so the market's pretty apprehensive about it. We've seen the dollar index soften a little. So this is over the past week. We can see the dollar index go down, not insubstantially. And this has kind of helped support flat price this morning as well, above 82.50, just kind of as it has been weaker. The J-Powell's come out this week and said there's a long way to go to bring inflation down to 2%. The Fed meeting isn't until the 14th of December, I don't think, but there's like plenty of room for these inflation headlines to undermine the confidence and the potential for a strong dollar if inflation stays strong. I think the potential for the CPI release today to kind of cause this strong dollar, which is already, it's been pretty strong like all year. I think I've got a longer term graph. Yeah, so this is over the year. I mean, it's at really strong levels, and this has been like obviously a force bringing down Brent, but in terms of like the CPI release today, I think, that will be the important thing, watching the dollar. And then of course the build up. As always, it seems this year we've always been building up to a Fed meeting, and we are again building up to a Fed meeting a month today. We're looking at like a 14% chance. This is on the CME Fed Watch tool. There's a 14% chance they're going to increase by 25 basis points, but the majority of the market believe that they're not. Of course, looking at next month, that in turn is higher believed likelihood of them increasing. But this is a lot higher than this time last month. I think it was in like low single figures then.
It's a risky move for the government as you head towards election, because I guess it would likely disrupt the whole soft landing concept, but then you have to balance that with inflation. But no, that's super interesting. And I do agree it's one to watch, because as we said, if the professional commercial traders are out of the game right now, then what's moving the market is more macroeconomics by the hedge funds. And there's a lot of technical traders who trade off dollars. The US dollar is literally trade the correlation. So I think you're right. That's highly, highly likely, and probably more correlation with the S&P and things like that going forward, I would say. Good stuff. And on the product side, what can we say about the refinery margins and what's been going on?
Okay, so looking at the week-on-week refinery margin change, this is Monday to Monday. We've seen a slight increase in this is December, 99-cent increase, and that is purely it's driven by dated Brent weakness. It's been so significantly weak that even though every single product has weakened, we're still seeing an improvement in the refinery margin. It's like really significant. It's replicated in the Asian refinery margins as well. And what is bringing them both down is gas oil. It's a huge decrease. It's a massive weight on the margins, and it kind of brings into question this kind of light heavy prioritization. Again, I'm sure OPEC wouldn't be happy to see that this is the thing that's impacting the refinery margins the worst. In both regions, we've seen such a weak gas oil market recently. I can show you some technical indicators. So this is the January gas oil future. It's absolutely dropped off a cliff recently into oversold territory. OI is kind of, I guess, day on day stagnating, but it's high, it's increasing. People are willing to go short in this.
It's outpacing the move in flat price as well. So I mean, I think we've said it recently on other podcasts, like it's still historically a high enough level that you're comfortable being short. I mean, and it is seemingly the one crack that needs to give way, given that there's not a hell of a lot of indicators that are supporting it on a sentiment basis. It is really quite a localized, maybe ARA story if you're bullish.
But with the ARA, the stocks, there's a week-on-week drop in stocks, and it just falls on deaf ears. It's 47,000 million ton drop in ARA stocks last Thursday. And I mean, you can look at the price action, not seeing any support there. Not at all.
Well, there you go. Probably points to, again, it being more macroeconomically driven.
Yeah, it's a demand story in both regions.
Yeah, well, there you go. I mean, it's that's a lot of weakening sentiment on the refinery margin side, the product side, and it started with gasoline a couple months ago. And then once we got low enough in gasoline, people started buying that, and now it's shifted to selling gas oil. So the market's just steadily pricing in, it seems like, oversupply across the board. Having said that, VLSFO had that huge rally we talked about last week, and it's kind of sustained itself, hasn't it? So that's, I guess, one area, not a huge part of the barrel, but enough to kind of help some localized heavy demand, I guess. But yeah, towards the end of the year, it seems like we are going to continue this kind of bearish theme until we get more clarity on how OPEC move forward. So in terms of trade ideas then, what have we got for this week?
So this week we are staying on the kind of middle distillate theme and looking to long the Q1 regrade, really high levels the other day, and then there was a really big sell-off here and we started to see a little bit more support. So we'd be looking at maybe a momentum trade here as the market kind of piles back in. But it's kind of quite fundamentally driven in terms of reasons why. I think that beforehand I've been actually quite bearish regrade in the new year anyway, because of the El Nino weather event, which was meant to cause a warmer winter in kind of the Far East, but more recent weather forecasts have shown that that's actually probably not going to be the case, and we've had weather temperatures forecast to drop below the 30-year average almost nationwide. After there has been this period of warmer than usual weather. I know that ski resorts in Japan have been told, like, don't worry about it anymore, after being told to, worry about it in terms of skiing. And the West is going to get some below average temperatures, 40%, just kind of weather talk really. But I think it's very easy to believe weather reports, but they are like pretty fickle. And I think that it's important to kind of take them with a grain of salt, which is why it's easy to get swept up in the El Nino, I think, especially after hurricane season. And we did have more hurricanes because of it. But we have to look at other factors as well. So we've got the Lunar New Year in the East in the new year, and that should bring a significant uptake, which we haven't really seen in this part of the curve yet in kerosene. So there's still room to improve there. OI is healthy, but it's not ridiculously high. So there's room to get better here. But I think that the two things that really this kind of trade depends on is the Chinese exports and the refinery margins. And so it's whether they are prioritizing kerosene, which would drag down the regrade, or gas oil, which would be more supporting of the regrade here. So that's something to consider, and also how they choose to export either of them. I know we're not getting any more export quotas for the rest of the year. So they're the things to really be keeping an eye on here. Yeah,
I think the prioritization of refiners is a good thing about looking at the forward curve, is can just tell you what the refiners are going to do. Ultimately, regrade jet or kerosene versus gas oil, it's negative at the end of the day. So they're not going to prioritize it.
No.
Even if you expect demand, you need to see it in the forward curve. You need to see that you can lock that in at a very minimum. So I think that works in the favor for the trade. If anything, continuing to move, to not actually produce, if anything, incentivize gas oil. But it's an interesting one, because I remember some people have been saying Q4 is a great seasonal trade to be bearish oil or bearish crude, and it's just played out in the charts. But historically, it was always told that Q4 is kind of a demand season because of kero, basically, because of the heating demand, like you're saying, in Asia, and the fact that kerosene is still used for heating and cooking. So festive season as well is probably something to do with it. People flying around more could help the jet side of that argument. So it's an interesting one, and I quite enjoy seeing, and I think the astute kind of trader in the futures and swaps can say, when we had such a big move, we have a regime shift in Brent and a restructuring of the refinery margins, something in it, one differential somewhere is going to be out of whack. It just tends to be how it happens. Nothing moves so perfectly in line. So maybe it's the regrade. Maybe a lot of the recent sell-off was just a function of Brent.
Yeah.
It could easily just be a sentiment thing. A lot of people just like to, when I was trading, actually my last place, I remember we was getting direct flow when the market was selling off in 2014. It wasn't there are kerosene traders and they could have just sold Brent, but they were saying, where's your bid for kerosene? Okay, sold. So they're selling flat price kerosene. And it was just, maybe that was just their mandate to trade. So they chose, that's how they were going to get short. There could be an element of that, right? It was the best way to express a bearish view in their market. So they're just selling the regrade because of Brent weakness. It's very likely. It might seem nonsensical, but there's probably an element of that. And on the rebound, as you say, if it makes fundamental sense to be bullish, and especially as it's Q1, it might just be a it might just be a good trade. At the end of the day, there's no reason for it to be deeply negative. It's not like we're in a very high level. So I can see the ethos in your trade. So it's a bit of momentum. So we've had a bit of a crash and then it's a recovery. It seems highly correlated to Brent actually, but what are your thinking on like tradecraft, trade structuring on that one?
So in terms of tradecraft, I mean, recently we've not seen it be super volatile like intraday. Because this is a momentum trade, we'd usually be looking at having quite a tight stop because like it's quite short term and trying to get the move up. But because of the market itself, the regrade market, we'd actually want quite a wide stop because we want to make sure that the move down is a meaningful, genuine flow because of like the way the market's structured. I was talking to our distance trader this morning and he said that would be a really important factor because especially of like seeing how genuine the flows are. So that kind of brings it a little bit trickier. But I think it would also be really important to monitor volatility because it's not super volatile now. I think that monitoring the volatility to see that maybe when the momentum is over, that would be a worth thing for like stopping out and
taking profit type thing on it. Okay. Yeah, I mean, you could probably play it out as if you're going to have a wide stop, you probably need to want to be in that trade for a while. You want to see this material moved up. And it looks like, as I say, historically, it's not in any particular level that would be, you couldn't have a decently strong move. This is in dollars per barrel. So even if it was to go back to flat, we're looking at like almost $1 per barrel. So there's a lot of movement for the contract to rally. So yeah, I can understand your logic. You think there's been you're basically trading a long-term view and you're just taking the kind of volatility you had maybe a week ago as a blip. Sudden rise up, quite aggressive, crash back down, but then generally speaking, there's been the long-term trend. So you just want to stay in that long-term trend with a wider stop. Yeah. And kind of start to take profit, at multiples of that stop loss. Yeah, fair enough. Okay, cool. So, I guess just leaving the end of this, again, it is really about OPEC, and you can probably almost guarantee that the majority of the open interest decline was de-risking on, the end of the year, but also because they're awaiting what these guys are going to do next. And as if this year's taught us anything, you genuinely can't put on a position without knowing what these guys are going to do next, because, calling a bearish market because of what you're seeing is fine. But ultimately, the Saudis in particular have gone deeper and deeper every time. Yeah. Will they do it this time? And we did a poll on LinkedIn, and it looks like 85% of the people who voted, it's 114 votes, pretty reasonable, and they all think they're going to extend the cuts into 2024. If that's the case, I guess people are kind of waiting for that to be confirmed, and we could get a rally here off the back of that. And as you said at the beginning of the podcast, with liquidity being low, that announcement could cause a pretty serious rally with not much kind of selling flow out there now that we've consolidated, and a lot more kind of volume waiting on the sidelines is the kind of ethos. So yeah, I hope that's been interesting for everyone out there, and please join us again next week for more of the same. Thank you.